Now, our reconstruction of the cash flow statement into a more appropriate cash flow statement that's relevant to the financial team starts with something called the cash flow identity. And the cash flow identity says that cash flows from assets, meaning any cash or any cash that is generated by the assets of the firm, has to be equal to cash flow that comes in or is paid out to creditors, which are the people that provide loans. Creditors and bondholders and all represent the people who make the firm a loan, who provide debt financing, plus cash flow to stockholders, who are equity holders or owners. These are the people that own shares of the firm. And this identity, again, describes something central about how cash moves through the firm. For instance, any cash generated from the operations, from assets, if there's any left over, it has to be paid out to our creditors. We're paying off our loans, or it's shared to our stockholders in the form of dividends. On the other hand, if the cash flow generated from assets is negative, meaning that the firm is losing money, and this happens a lot with young firms, the cash that props the firm up, that provides for those losses, has to come in from the outside, meaning we have to get a loan or we have to sell more shares in the firm. Right? So this identity, it describes the relationship between cash about cash in the firm, and much like the balance sheet identity, it isn't true because we want it to be true. It's true because it has to be true. There isn't another way to go. Cash doesn't disappear. Cash is either spent or saved or is paid back. Okay. So that the cash flow identity itself then moves from two different places. We can either bring cash in or pay it out to outside investors, creditors or stockholders, or we can generate or lose cash from inside the firm. And that gives rise to two different perspectives within this cash flow statement. All right. Now, everything that we need from the cash flow statement is going to come from the balance sheet and the income statement. So here's those balance sheet and income statement for our simple firm. And what we're going to try to do is understand how the cash moves through this firm. Okay. So from the outside, so the one hand of the cash flow identity says that cash flow from assets is equal to cash flow to creditors plus cash flow paid out to stockholders. This is called the capital supplier's perspective or the investor's perspective. In other words, this is a way to get a measure of cash by looking at how the cash left the firm. Now, cash flow to creditors is defined as the interest paid minus net new borrowing. Okay? And so we can find both of these things on the balance sheet and the income statement. Right? You can look here and see that the interest paid on the income statement is $70 million, whereas net new borrowing is the difference between long-term debt in 2012 and long-term debt in 2011 on the balance sheet. And you can see that that's about $46 million. So if I subtract interest paid minus net new borrowing, I get a positive value of 24 million. Now let's think about what this actually implies. Interest paid is money that we are paying out as we are paying off our loans. Net new borrowing, if it's positive, means that we borrowed more money, we took out new loans. And we can see that that's the case here because loans went up, long-term debt went up from 408 million in 2011 to 454 million in 2012. That only happens if we take out additional new loans this year. Okay? So we paid off some old loans, we can see that from the interest, but we also raised and took out additional new loans. And so the cash paid out, the fact that we paid more interest than we took in new loans, means that we paid off some of our outstanding debt, but not very much of it. So 24 million went out to the firm's creditors. Cash flow to stockholders is a very similar measure. It's dividends paid minus net new equity. And again, this is almost exactly the same interpretation, where dividends is the money that we pay out to the firm's equity holders, the owners of the firm. And net new equity describes whether we raised any more money by selling new shares or whether we bought some of our old shares, called repurchases. So these come from the balance sheet and the income statement, same as as on the creditor's side. Dividends comes from the income statement. It's down at the bottom. It's part of net income. Dividends paid out to our equity holders in 2012 was $103 million. So $103 million was generated by the firm and paid out to its equity holders. On the net new equity side, we can see that when we look at common stock and paid in surplus. We can see that the firm increased the value of common stock from $600 million to $640 million. And once again, the only way to do that is for the firm to sell new shares, either to existing shareholders to increase their ownership stake, or to totally new shareholders that haven't owned a piece of the firm before. And we sold an additional 40 million of shares. So we brought in some money from that. So we raised 40 million from selling new shares, but we paid out 100 million to our existing shareholders in the form of dividends. And we can see that 103 million in dividends minus 40 million in new equity means that we paid out a total of 63 million to our equity holders. That means that the cash flow from assets, from the capital supplier's perspective, if we add those two things up, cash flow to creditors is 24 million, cash flow to equity holders is 63 million. We add those two things together, we get 87 million. But that money, again, the cash flow identity says that money has to come from somewhere. We don't just pay $87 million to our creditors and to our owners out of nowhere. The only way that money gets generated to pay out is if the firm is making a profit. If the cash flow generated from the assets, the operation of the assets of the firm, is profitable. That's the other side of the cash flow identity, what we call the free cash flow perspective. And that says that cash flow from assets, the operating description, is equal to operating cash flow minus something called net capital spending minus something called the change in net working capital. And if we describe this formula in words, operating cash flow is the money that the firm generates from its operations. So revenue from operations minus cost from operations. Whatever left over, this is money that we can then put to use in the firm. Right? So operating cash flow is EBIT plus depreciation minus taxes. This is a measure of the cash generated by the operating of the firm minus the cash paid out in the costs of operating the firm. Whatever's left over after operating cash flow, this is money that can be put to use by the firm. And we can put it to use in two ways. In the first way, what we call net capital spending, we can spend some of that money. This is retained earnings, so to speak. So we can spend some of that money from our savings account, this leftover cash, in order to make new investments in the firm. So we might need a new truck, or we might need some new computer equipment, or we might need to replace some aging machinery. All of these are capital spending items. And this is the change in fixed assets. So ending fixed assets minus beginning fixed assets plus depreciation. So what we're after here is, did the firm use some of the leftover operating cash flow in order to fund any of its new fixed asset purchases? Alternatively, it may have tried to make up a loss in operating cash flow by selling some of its old fixed assets. And that would also be represented in capital spending. It can be positive spending or negative spending. And finally, if there's money left over after that, the firm might make some change in its net working capital accounts. This is our short-term operating budget, and it's going to include things like cash and inventory and accounts receivable minus accounts payable and notes payable, right? So if this value is positive, then the firm has more money than it needs to pay its short-term obligations. And the change in net working capital from one year to the next might indicate that the firm is changing the way that it operates in slight ways. So for instance, the firm might have almost run out of product in 2011. And because it recognized that it almost ran out of product, it increases its inventory holdings throughout 2012. This is an investment in net working capital. It is putting more money into inventory to make sure that it doesn't run out of product in the next year. That investment that money to invest in more product that we haven't sold yet has to come from somewhere, and it comes from any excess operating cash flow that we might have that we haven't spent on fixed assets. Alternatively, if a firm had really paid attention in the early parts or the later parts of last year, the early parts of this year, and been able to successfully predict the pandemic, another potential investment in working capital comes from a firm saving a lot of cash in its savings account. So we might take some of this leftover operating cash flow that we don't have a specific use for and put it into the firm's cash account as a precaution against bad times in the future that we are predicting. So this is the other side of the identity. The money that we just paid out, the $87 million that we paid out that we paid out to our investors, that $87 million is what's left over after we pay all the costs associated with operating the business, we make any new investments in fixed assets, and we make any needed investments in working assets. Whatever's left over, then we must pay out to our creditors or our stockholders. So this is the formula that we'll make use of most, because this is the part of the identity that the management team has the most control over. This is the part that describes the cash as we operate the business and make investments on a day-to-day or year-to-year basis. So operating cash flow minus net capital spending minus the change in net working capital. And again, all of these things come from the balance sheet and the income statement in some way. Operating cash flow is EBIT plus depreciation minus taxes, and these all come from the income statement. EBIT is our earnings before interest and taxes, so this is what we call operating profit. We add back depreciation because remember, depreciation comes before EBIT. So we subtract depreciation from revenue to get EBIT. But depreciation is not actually a cash expense. That is not money that we spend. It is simply an accounting item that allows us to match revenues and costs. So we don't want to include that in our measure of how much cash the firm generates. So we add it back. And then we subtract taxes because we do want a measure that includes the taxes that we pay on our operations, because this is pretty central to the operating of the firm. Any money left over can then be used to make investments in fixed assets or working assets, or can be used to pay out creditors.